Who would have thought that at the beginning of 2011 that we would have actually seen Germany battling to sell 6 billion euros worth of bonds? We're starting to see a very big shift from just peripheral Eurozone being, of course, debt-laden and increasing borrowing costs, now moving more to the core Eurozone. How's this shaping your thinking with regards to asset allocation as a whole?
That's right. I mean, the European debt situation has clearly spread away from just the smaller peripheral countries such as Greece, Ireland or Portugal. Italy is in the thick of it, so Spain. French yields are rising as well. And yet we had yesterday's news in terms of the German debt auction. I happen to think that the news yesterday is actually very good news, because it's a wake-up call that Germany is not immune to this. And in my view, policy has to change from Germany and the ECB in order to take the heat out of this crisis.
Would you say that the clean-up costs now of the overall debt scenario that is hanging over the Eurozone is just going to increase dramatically, and then we do need to see a stronger EFSF, we do need to see stronger movements coming through from the ECB and the IMF? You're talking about policy changes. How imminent are these? And do you think, you said it's a wake-up call for Germany and France especially, what kind of movements can we expect by the end of the year, or do you think it's going to be something that's going to be deferred into 2012?
We're not going to have any magic solution to this crisis. So the crisis will go on for a long period of time. Debt levels are going to be higher in a year's time than they are today. So we know that as a fact. What needs to happen is that the severe pressure in the sovereign debt markets needs to ease. And in the current state of play, the only way that can be achieved is through a more proactive German and ECB stance. Now, I'm not advocating printing money to create huge inflation over the long run, but by purchasing government bonds in a more aggressive fashion, they could create a breathing space whereby governments can actually make sensible medium-term decisions rather than these short-term ad hoc policy measures that change every 2 months.
With regards to what we see out of China, we had the flash PMI number disappointing this week. We're going to see the official number released next week. We still have troubles coming through in the US, where we've got a little bit of good news on the economic front, and then that counteracted by bad news on the economic front. What is your sense with regards to a possible recession coming on once again on a global level? Do you think policymakers are going to step in and then embark on quantitative easing in the US if required, and the policy changes that we need to see in Europe, and then of course China perhaps easing monetary policy?
I think in the US, if required, they will act. The Fed has been extremely proactive so far during this crisis, and I think it should be commended for that. Although my base case view is that the US economy is actually chugging along on a gradual path of recovery, and the jobs data is actually generally of an improving trend. So I worry less about the US. The situation in Europe is what really could prompt a much more serious situation than we're already in, if it leads to further global contagion through financial markets. The situation in China, they've been trying to engineer a slowdown for some time in the economy, and they've been quite successful in that now. The inflation is coming down, and it's natural that growth is slowing down. There are some areas where maybe you have some concerns, particularly property, I would say, but I would expect over the next year or so we'll see easier policy in China, and the long-term growth prospects are still very good there.
Okay, now that we've set the scene and we have a sense in terms of what you feel with regards to the big economies on a global level, let's look at asset allocation right now. You're actually overweight US equities, which is quite surprising. Give us your thinking behind that strategy, because if you see what, for example, the Dow Jones has done over the last 10 years, it hasn't moved very much. It's still sitting at a relatively high PE relative to some of the emerging market countries. Sure.
I mean, the first point, of course, is that judging the prospects for the future on the basis of past performance is clearly not a good way to go, because otherwise 1999 would have been a best time to buy tech stocks, for example. We're overweight currently US and Asia ex-Japan in terms of our regional equity exposure. Equities are roughly around a neutral sort of level currently. So the reason for the overweight US position in the current circumstance is that I believe that US equities are fundamentally less risky than the majority of regions around the world, because you have a proactive central bank, you have very strong corporate balance sheets, and I view less earnings risk there than elsewhere in the world if the global economy is going into a slowdown.
Are you talking about US equities that are predominantly strongly based in the US, or are you talking about multinational companies which also have a very strong footing in various geographies across the world?
I think both. I mean, if you buy the US index or a US equity fund, you're going to generally have exposure to big cap companies that have got exposure all around the world. And a lot of these companies have good, strong, sustainable dividend yields. and they're able to access growth across all emerging markets.
With regards to, you said Asia ex-Japan, it's interesting because Warren Buffett actually this week came out and said that he's actually buying Japan and Japanese equities. Why not Japan? And give us an indication of, I'm sure you're really talking about China here when you say Asia ex-Japan.
Yeah, our focus there is on China and Hong Kong, and the thinking specifically with regard to that is that I do expect a shift in towards looser Chinese monetary policy, and I think the market has been very concerned about fears of a hard landing. Valuations are very low there relative to history, so that's the case for Asia ex-Japan.
Well, with regards to your percentage exposure, equity exposure from a percentage perspective in your portfolio, give us an indication of what percentage you're actually invested in Asia and also the US.
So in terms of our replica asset management fund, which is our largest multi-asset fund that we run, equity exposure is around about 33% currently. Roughly half of that is in the US, and then probably around a third of that is related to Asia ex-Japan.
The rest?
And the rest is that we have some in Japan, and we have a little bit in Europe and UK.
With regards to the rest of the, say 70% of the portfolio, I know we chatted a little earlier, you said you're starting to downgrade your exposure to sovereign debt, not surprising there because there are quite a lot of risks. What are your views on US Treasuries? I'm sure that European bonds right now are not looking very attractive because they're just far too risky. What about gold? What about the rest of the asset classes?
So we're currently holding around 25% cash. Well, held in terms of treasury bills in the UK, US and Germany, and then the remainder we have exposure to corporate bonds and some emerging market debt. We've actually cleared out the remainder of our UK and German government bond positions now, because in terms of developed market government bonds, you've got a clear bifurcation between bonds that are viewed as risky in terms of credit risk, there's default risk there, and bonds which are viewed as safe. Now, I think there are better ways to take on credit risk than in sovereign debt, so I'd rather take equities or corporate bonds. In terms of the safe haven bonds, they've now rallied so far that on a medium-term view, it's very unlikely that you're going to make very much money in holding those, so we've cleared out that position now.
With regards to gold, do you have exposure to gold?
I don't have a strong view personally on gold. I think it will continue to be a diversifier. The only thing I'd note about gold is that its properties seem to have changed in the last 3 to 4 months or so, where it's starting to be positively correlated with equities, whereas previously it had been negatively correlated. So that's something to watch in terms of the characteristics.
And what about property, very quickly? Do you have exposure to property?
We don't have a great exposure. Again, you want to look at the characteristics, whether it's behaving like an equity or behaving like a bond. My sense is here people view property as a bond alternative, whereas in a lot of developed markets it trades more like an equity alternative. I think going back to the US, I think one area that is low risk looking forwards over the next 5 to 10 years is US property. We've worked our way through the boom and bust there, and I think that there's low risk on a medium-term view.